Hi, this is James Eng with Old Capital, and thanks everyone for joining the Old Capital Speaker Series tonight. We have a good agenda here. So we're going to have sort of a little intro from Old Capital, and then we're going to get into the an update on the market, sort of on the lending side, and a bunch of us just got back from Vegas at NMHC, and then we're going to have our two special guests, Jeremy and Aleksey, get into a little bit of a panel discussion. We had a ton of people register and a lot of questions come in. So hope you guys are ready. And then on the back half of that, we'll go for about an hour, and then we'll get into just some networking and for anybody who would like to stay on at that point. So here's a little bit of intro on Old Capital. So there's 10 of us, about half of us here in Dallas, half in California. And last year was an okay year. I mean, we did probably about 350 million in loans, mostly Fannie Freddie agency stuff. Did some construction loans all throughout Texas, and did some stuff up in Indianapolis and all throughout the nation. So overall, if tenure was below 4 a little bit longer, we probably would have done more. But overall, pretty good year. If you haven't seen us or followed Old Capital, there's a couple ways. Obviously, the speaker series is one, but then also the podcast we've put out for a long time. We put a lot of stuff on YouTube, and then also Julie hosts a Zoom at 8, typically on Tuesdays, as well. So if you have not followed us on one of those, definitely check it out. And some of our upcoming events, we are having a field trip. So we have done this a couple times, and people have given us great feedback on it. So we're going to do it again the last Friday of March. So if you are in town or like to come in town, we actually go out and see a lot of properties that we have financed. And so this is a great way to sort of get your hands onto some multifamily properties and put this as a soft pencil in. But the Old Capital Conference, we're finalizing the venue, but we are pretty close to it's going to be probably October 8th and 9th. So just pencil that in, but on your calendars for now. All right. Paul, both of us were out in Vegas with 10,000 of our closest friends in the multifamily space. I have some themes here, but I'll kick it over to you. Any themes that you felt was what you got out of Vegas?
Good evening, everybody. I'm Paul Peebles. Thanks for joining us and spending some time with us today. Um, yeah, Las Vegas. I don't think anything's surprising or shocking to anybody here in Dallas than Luca being traded to Los Angeles. That's shocking, as we would say. So nothing really shocking out in Las Vegas. Again, once a year, it's the big annual conference, whether it's lenders, investors, institutional people, developers, everybody gets together and talks about multifamily. It was at the Aria Hotel, huge group all gets together. It's like I call it the the men in blue suits because it's everybody's usually wearing a blue blazer and khaki pants. But the overall, I wrote down some notes that I thought I'd just kind of share with you. Overall, the conference was very positive, almost too positive for guys that buy the B and C properties. So the long term that I was thinking is that apartments, as in an asset class, the A properties were very bullish, especially in high growth in business friendly environments like Texas, especially Dallas. And if you take a look, the institutional buyers are really back, and they've been back for probably about a year or two. It is the syndicators that are trying to raise money. It's a little bit difficult. Shows short term. Kind of the theme was there was a lot of concern. Interest rates are relatively high, and I mean relatively is a relative word because it's a matter of perspective. Rates a few years ago gave us low rates like SOFR at 0.05 plus a spread and Fannie loans at about 4%. But if you look what they were when I first got into the business about 38 years ago. Rates were at 10, 11, 12%. So when I see rates today being at 5.5 or 6%, it's relatively pretty damn low. So, but what we're seeing is, I think, is the overall. Uh, they were very positive on the long term, but knowing that there was challenges in the short term with concerns with a lot of some distress assets in the market that haven't traded or haven't been foreclosed upon. Interest rates are still high, and cap rates have gone up, and so values have come down about 20 or 30% across the board on a lot of these B and C properties. So that has made it difficult for a lot of syndicators to raise capital. And so that's where I think today is what we're going to talk about, some of the things that we've learned, I've learned over the last, say, 35, 36, 37 years. And then we'll talk a little bit to the guys about, what they're going to talk about. So I'm really excited to have Jeremy and Aleksey here to talk with us.
All right. Yeah, I wrote down a couple things. So you hit on A versus B and C. We're still seeing A class stuff trade sort of five caps plus or minus 25 basis points. The B and C, I mean, I think brokers are still trying to sell B and C at 5.5, six caps, but really it's probably 6 to 7 caps out there.
At
So
least.
not a lot of stuff. Yeah, not a lot of stuff is trading in the B and C space that we're
Yep.
seeing. And the distress is coming. So we talked to some lenders out there, and their patience is wearing a little thin. And that first extension, I thought, they pretty much gave for free. They didn't require a pay down. But the
Yep.
second go around, when you're coming up for the second extension, they're asking for a little skin. So that might be, a pay down on principal or an interest reserve or capex reserve. So they're coming up with a little bit more skin on that second extension. We're seeing some of these swap outs where the bridge lender is saying, well, we appreciate the time that you've put into this deal for the last 3 or 4 years, but we're going to switch you out with the new guy. And, our airplane analogy of the pilot, you're getting switched out. And so they're bringing in a new pilot with, that's coming with fresh capital and a little bit different experience potentially in that
Right.
market. Um, and then we've seen sort of a new class, I would say, new class of 25 and 26 that maybe they worked for big operators, and those guys are having issues, and now they're coming out and starting their own shops. So new class of 25 and 26, and they're out raising money right now. And I heard this on the way back to the hotel at the end of the night, and basically said the guy was screaming, "Only way you get hurt on a roller coaster is by jumping out." So I thought that was perfect for, when a lot of these deals that were bought in 21 and 22. You're midway through the roller coaster, and you're gonna have to work through the trough here, and it's gonna take a little time. So we're gonna try to hang on here, and I went with survive to 25, and I stole this from someone else, persist to 26. So it's gonna be another year, I think, to fight through here. So anything else from NMHC, Paul, that we didn't touch on yet?
No, I just think that the theme really was supply has peaked, rents have kind of bottomed out, and then demand is robust. So they're thinking that they're going to have positive rental growth in 25 going into 26 because of all these properties that were being constructed that's down by 85 or 86%. Those properties that were started a number of years ago, now they're going through lease up, and now whenever they're done, they're not really building any new apartment supply to any great extent.
Got it. Okay.
So I think that's kind of our theme.
All right. So I just threw up. So I mean, 10-year definitely ran up over the last, let's say, 60 days, but it's come back. It's retreated a little bit. So this just gives you an idea. We had some people ask questions about sort of where we're seeing rates right now. Freddie Mac SBL is where we've done a lot of loans, sort of that 675 right now. Freddie Mac, we're still conventional side with some buy downs. You're getting into sort of the high fives. Same with Fannie Mae. And the most surprising thing, we talked to a lot of non-recourse bridge lenders out there, and they are, pretty. I don't know what the right word is, but they've been pretty aggressive on in terms of what they're willing to lend at on some of these deals. And so the spreads that we're seeing on some of the non-recourse bridge are like, mid to high twos over SOFR. And so they're getting definitely more aggressive on some of that stuff. And so,
I,
yeah,
I will say one thing is that I think our business on the old capital lending side is kind of like a barbell, is that the institutional people that are buying a lot of this stuff on the A class property, it's very robust. And then the smaller business, anywhere from $1.5 million, say loan amounts up to about $7 or $8 million or so. That's still fairly robust because you can raise capital in that size. Those equity checks are not big. It is those transactions between 15 to say $30 million. Those deals are stuck in purgatory as I see, and because it's very difficult to raise 8, 9, 10, $12 million with $100,000 syndicated check writers these days. So even though our volume was down significantly, but we're doing more numbers of smaller transactions for people that want to start to get back into the business at that period of time.
right. Okay. Perfect. So let me bring Jeremy and Aleksey on. I met Jeremy, I don't know, if I feel like at least 7 or 8 years ago, and I listened to everything that he puts out. And then Aleksey, you're relatively new to me. But I feel like I've read everything that you've put out, and you've put out a ton of stuff. So I appreciate you guys jumping on. But maybe for people who don't know you guys, maybe haven't followed you guys, give people a little background. Maybe we'll start with Jeremy and then go over to Aleksey.
Yeah, thanks for having me on, James. Thanks for everyone for joining us, and I definitely look forward to all the questions. Hopefully, it could be as helpful as possible. So, my name's Jeremy Roll. I'm originally from Montreal, Canada. Lived in the U.S. for about half my life. I'm currently near Newport Beach in California, where I live. I have been investing in syndications as an LP investor since actually this month, February. It's 23 years, which is crazy. And but I've been doing it full time for 17, almost 18 years now. And so I've invested in many different asset classes. I'm kind of heavily diversified across all asset classes, including multifamily. I invest in different types of multifamily, both in terms of class of multifamily, but also business plan within multifamily, such as normal market rate stuff to low-income housing tax credit to tax abated, and watched, definitely went through the last cycle. Believe that we have a high probability based on data alone of another cycle ending and resetting here soon, for many reasons. And so I'm being very cautious at the moment. And I want to thank James. If you guys don't watch his YouTube channel and other things, he just puts out tremendous content. I really try to listen to all of it. And I just love that he's so transparent and really helpful, being from the industry side, trying to help everybody just to see the truth and the data. And also Aleksey does a great job of being very transparent and trying to bring kind of reality and everything else and just telling it like it is. So thank you guys, both of you. Seriously, I really, really appreciate that as an LP. So thank you.
All right. Thanks a lot, Jeremy. And Jeremy, you are in California.
Yeah, near Newport Beach in California.
All right. Perfect. Aleksey, go over to you. Just give sort of a brief intro to yourself, and then we'll jump in here.
Thanks for having me, first of all, and thank you for the kind words, both James and Jeremy. It's really nice. By way of background, I worked at a public real estate investment trust, where I ran a $10 billion real estate portfolio of like existing assets, and we also bought roughly like somewhere between 1 to 2 billion per year as well, and I managed that process of like underwriting new transactions, thinking about risk, figuring out which stuff to buy. I sat on an investment committee, et cetera, et cetera. So after leaving that job, I decided to go after the what I would call not so transparent marketplace of GPs and LPs, with the goal of trying to make it more transparent. That's like sort of what I'm going after at a high level. Part of that is me writing. I write twice a week on lplessons.co, and starting other things as well. But that's sort of like the driving, I guess, um, mission statement, let's call it. And I'm happy to take any questions, of course, but don't want to take too much time.
Okay. Um, Thanks, Aleksey. Aleksey, can you bring your mic up just a little bit on the sound? That would help. And
Yes.
then, yeah,
Is
that's
that better?
perfect. Yeah, Julie, can you see okay now?
Sorry.
I just see the passive investor panel.
Okay, you can't see. You can't see Aleksey.
That's what I see too.
Yeah, we need to change it to speak off of the share.
Okay.
There
we
you go.
Okay. How can we see the slides?
Okay, I didn't know if you wanted to have their picture so that they could see everybody speaking.
Okay. I'm trying to see. Let me see if I can just share this. Is that better?
Yeah.
Can
Well,
you see
I thought you'd have their pictures when they were introducing themselves, but that's okay.
Aleksey? Can you see the slides? And can you see Aleksey now?
So I can see the slides. I also see myself, but
Now I can see them.
And I think
You can see
Yeah,
him
it's
now.
good.
Okay, sorry. I was
Yeah.
sharing the whole screen, so it was just my screen.
Yes.
Okay.
Correct.
All right. Perfect.
good.
Well, thanks, Julie.
Yep.
So I guess to kick it off, I'm going to hit you guys with sort of 4 or 5 broad themes, and then I thought we get into some of the questions in sort of a rapid fire, quick fire session, I guess. So I guess let's just start with Aleksey, since you're on the mic here. The current state of the LP market. What are you thinking on that front?
yeah, a lot of thoughts, but I'll try to summarize. So, um, if you compare to the state of the market of where LPs were in 2000 and call it 21, 2022, and really I'm just referring to like the low interest rate era. Um, I think a few things have happened. The Broadly speaking, I'd say some LPs that, in my opinion, shouldn't have invested, are realizing that, and as a result, they're many of them are not coming back to invest at all. Um, at the same time, many are realizing like, oh, there's good years and bad years, and I really need to do diligence, right? And so I think what's happening in terms of like investor preference is people are almost like picking sides. Like this is what I've heard from speaking to all the LPs I speak to, is just like either you're in and like you need to get educated and like understand what you're doing, or you're out and like I would just rather invest in the S&P. That like that type of mentality. Um, Another thing that's happening, and that's just as a result of like risk-free rates, if treasuries are still risk-free. I always have to insert that joke. Um, yeah, like you're basically you've seen like a pretty drastic shift, I think, in terms of like pref expectations and splits, right? And that's normal, like prefs, splits, all alignment of interests between GPs and an LP are sort of it's really just a marketplace, right? Like if a GP can raise with the best terms to themselves, they'll do that, right? And they're incentivized to do that, and there's nothing wrong with that, right? And so, however, what has happened from 2022 to today, let's say, is like just for to give some examples, concrete ones, like it was pretty normal to see like a 6% pref with like a 60-40 split on a 1970s deal in 2021. Nowadays, that's not normal at all. Like prefs on average are solid, like a solid 8. It's very common to see 75 25 splits. In many cases, I already see 80/20s, right? And so these things have shifted in the benefit of LPs as GPs are trying to attract capital. I'll stop there. I mean, I have other thoughts, but I don't want to take over the room.
Yeah, Jeremy, what are you seeing in terms of I mean, you talk to a lot of LPs. What are you seeing out there in terms of what they're looking at to invest in and how their current deals are going?
Yeah. So first of all, I just want to echo, I'm not going to repeat everything, but I obviously agree with everything Aleksey said as far as what's happening. Just broadly speaking, especially if there's anyone who's relatively new to the space, this just like real estate, this entire syndication process is cyclical. And so what Aleksey described was basically a cyclical reset where there's a much lower supply of capital from the LP side coming, and therefore the terms are going to be better. And what it also typically would mean is that rather than being forced to invest in funds, which are more efficient for sponsors to raise capital in, now as an investor, you get to cherry pick individual deals more commonly, and you'll see less funds and more individual deals, both because they can't necessarily raise a capital for an entire fund, but also because on average, typical investors, if you were to poll everybody, from what I found over the years and the decades, is that people prefer to be able to choose property by property. So now they're catering more to what the LP wants because they have to, right? Because the LP is more in the boat, which is good news on the LP side. I think generally speaking, the challenge we're having in the market, I know Paul had touched upon this, is the lack of being able to raise capital in that 10 to 30 type million or a little bit higher, which is basically what I call the non-institutional accredited investor space. And it's actually fairly obvious what happened, and it's just unfortunate. Back in 2021 and 22, as an LP, I'm on many different distribution lists. And what I commonly saw was literally those years, 90% plus of what I received was multifamily, value add, floating rate loan opportunities. And meaning that I almost had to invest in those to do anything, because that was almost everything across all the asset classes and across all the types. Well, there was such a high concentration of investors who went into those who just wanted to do stuff that now everyone's sitting in the same boat, having the same challenges. To answer your question, James, but people are facing lower distributions, no distributions, capital calls, or worse, right? There's pref being inserted, pref equity funds being inserted on top of LPs and basically cram them down to zero. On the common equity side, there's the ability to maybe match those if you're an LP or not. Depends on what the verbiage and the requirements were within the operating agreement. There's a lot of factors. So to Aleksey's point, I can go on this for a long time, but what happened is that you have a lot of new investors who came in because of stimulus money and interest in trying to find anything that made sense, with a lot of good sales pitches of potential returns, and those aren't being met. And now a lot of people are exiting because they were fairly new. So this is not going to be an easy process for the non-institutional managers going forward for the next few years. We will eventually come around. My personal belief is that we've had one domino fall, which is increase in interest rates, which have caused a lot of this carnage. But I think we're going to have a second domino fall, which is we are still absolutely lined up from a probability perspective based on historical data for a very high probability of a recession. That's a second domino that really finishes a full reset. And when we're talking about persist till 26, and then people are expecting less inventory to be supplied, et cetera, well, that's all probably accurate and true from a data perspective. It's not taking into account whatsoever the probability of a recession, and that caused, persist till 27 or 20, whatever it's going to be next. So I think that's very important for LPs to consider. But right now, people have shifted away from common equity, are much more likely to look at pref equity, and a lot more likely to look at some form of debt to protect themselves. My fear is that you can look at debt, and yeah, if something's 10% LTV in a first position, you're probably very secure. But realistically speaking, if you're at the end, like if I ask anybody the question, okay, it's 2007, I'll just switch from common equity to debt. That's going to work fine? Well, it may or may not, depending on a lot of factors. So I would caution people out there that pivot reduces risk, but it doesn't necessarily mean it's the right time to do it, to do anything necessarily.
So you're saying the first domino was interest rates. Second domino is the recession unemployment, or is it S&P?
It could be either. I mean, in the end of the day, both in a recession, both would typically actually have negative impact on them. The question is a trigger. And if you look historically, the most common trigger of a recession in the US in the past is oil prices creating a shock and inflation and lack of affordability. The next most common is actually a stock market crash, right? And that can happen because of unemployment leading to slowing sales, leading to a stock crash, for example, right? One fascinating piece of data I'll share, James, and then I'll stop. I'm sorry, but is what's changed with this cycle compared to previous cycles, and especially 2007 and 8, and why it's taking longer for a recession to occur, which frankly is not even that much past the average amount of time a recession should have occurred, and based on the yield curve and how long it takes when it inverted, is that this time around, there were a lot more housing units built as multifamily and a lot less built as single family. And the amount of time it takes to construct multifamily versus single family is significantly longer. So if you take a look at a 12 to 18 month timeline on single family and maybe a 2 to 3 year timeline on multifamily, what normally happens at the end of a cycle is that the real nail on the coffin is housing construction ending, which leads to a lot of job losses. And that tips the employment numbers over. That's very common. And this time around, a lot of the job losses we haven't seen yet because a lot of it's gone towards multifamily construction. It's taken a longer time to occur. But I think we all know here that that multifamily supply is now ending. So that's one thing. That's probably the number one thing I'd be watching out for in the next 6 to 12 months is unemployment based off of the ending of multifamily construction.
All right. Aleksey, anything commentary on that second, third domino? I hadn't heard about the construction piece, and that, I mean, when you're driving around Dallas, there's still plenty of properties that are still trying to get done and
Yep.
are in lease up. So yeah, there is still a lot of jobs and unemployment still sitting at 4, right?
Yep.
So okay. Aleksey, any comments before we move to my second topic here?
Yeah, I think Jeremy's points were all on point. I have some thoughts on like predictions. I guess I could mention them now, but I'll just wait. But I think um many LPs do ask me like, do I expect another recession? When is it going to happen? How do I invest if there's another recession that's going to happen, right? And I think what I just try to remind people of is in investing there's like only so much that you can figure out, and that's just how investments work. And if you're not comfortable with that, you probably shouldn't invest, right? However, I think what's really important is when you're looking at an investment, um, what I always tell people is if you can't figure out, I ideally three, but let's say at least one, reasons why your investment would drop to like literally zero. If you can't figure that out, then you probably are not ready to invest, right? And I don't mean ready to invest in that opportunity. I just mean like you probably shouldn't invest in LP investments in general, right? Because what that tells me is that like you're not capable yet of figuring out like what could go wrong. And if in your mind the only way that you can lose money, and I've heard so many of these comments um from LPs that lose their money, like I thought the only way that I could lose my money is like a recession happens, right? Or I thought the only way I could lose my money is like, it's a fraud. Like surely I'll get my money back, but like that's just not how investments work, right? And so you know, um don't think that the catalyst to losing capital is another COVID or whatever it is. You know what I'm saying? Like there are much more real risk factors that should be staring in front of you when you're analyzing a deal.
Got it. Okay. Um, so we hit on this forecast piece. So I want to jump to the next thing, and I mean, it's a little bit of a tangent, but how have you guys started using AI as an LP, if at all? We'll go, Aleksey. We'll start with you
I
this time.
Yeah, I can start. The short story is I've tried, and I don't know, like I've seen a lot of people say like it's amazing. I have like somewhat of a coding background, so I'm not like too new to tech. Um, I've like plugged into like OpenAI's API. I've tried cloud. Like generally speaking, I would say it's very hard to use. In other
Very
words,
hard to use as an
like
LP. Okay.
um, I'm just being practical because here's the problem. Like if you want to feed it a deck, for example, and say, like, hey, what are some risks with this investment? Like, give me the top 20 risks or whatever. Like, I think it usually comes out with like 5 to 10 that are decent, right? But they're also like so general that they're
Too
just
general.
like not
Yeah.
almost not helpful. Yeah, it's like, oh yeah, an economic recession could happen and that can impact NOI. Now, I guess as an LP, if you're just starting out and like you might learn from something like that, like why not? It's free. Like it takes a second to pop the PDF in there. Just, consult your lawyers about, sharing stuff with it, whatever. That's a whole other topic. But like,
Yeah.
I just like I've been less than impressed. Like meaning, by the way, I use ChatGPT and AI daily. I almost think I almost use it as uh like a partner in my business. Like I just speak to it, and I use it as like a brainstorming tool, um, in terms of all types of stuff. But when it comes to like, hey, what do you think about this investment? What could go wrong? I just I've just found it all to be like not reliable. Like half the time it gets something super basic wrong. Sometimes you'll ask for it to scrape a deck for like basic information and it makes mistakes. So it's like I think it'll be super exciting in like a year, maybe sooner. I don't know, but like I just don't feel like we're there yet. What do you think, Jeremy?
Yeah, I think the biggest challenge is that as an investor, you're risking a lot of money. And for something that isn't, 99 or 100% accurate, it's really scary for someone like me to think to scrape a deck knowing that I'm going to get 80 or 90% good information, right? When I could just spend 30 or 45 minutes reading it instead, right? It's too much of a trade-off to me. I think we're going to get there, like Aleksey said. I think it'll eventually be very, very useful for scraping and summarizing a deck, possibly running some auto calculations on some models if you can get an Excel spreadsheet, to pull from. And I also think it will eventually be helpful for the legal docs, especially the operating agreement, where you can run through like, tell me the cash call provisions rather than having to find them. And you could probably ask, when it can get to that level and it's actually going to pull the right thing, that's great. But it's a big risk you're taking because the one thing it may miss would have maybe been the reason why you would pass. And I can't take that risk with this much money each time at this stage. So I'm not really using it at all yet, but I do think it'll get there and probably, within the next couple of years.
Yeah. I get an email a day on AI, so I just had to ask that question. Okay. So capital calls is like the four-letter word as an LP. It's the last thing you want to see in an email. It's buried at the bottom of the monthly update that this is coming. So I'm sure maybe talk from the perspective of how you're evaluating capital calls, either for your own investments or, I'm sure people have asked you guys to consult on these. So we'll go over to Jeremy first on capital calls.
Yeah, so I first of all, I didn't invest in any of the floating rate apartment bridge loan deals, so I'm not the best person to be giving an answer on this. I do have people asking about it, and I really caution people because it depends on your perspective. We're going to have a recession or not, and if you model in a recession, then you have to make adjustments to you're probably not finding a sponsor modeling it in a recession if they give you a projected model of what's going to happen at the property if the capital were to be provided, right? So you have to go in and do all this work to adjust that and be really conservative. So that can make it a really big hurdle. It's a very complicated equation, and I feel for people who are in that position, honestly. The best I could do, James, honestly, is give more the feedback that, to me, the number one lesson in the whole capital call problem is going forward, you absolutely have to review the operating agreement and the cash call provisions. Most people don't because, for example, the concept that a sponsor can bring in a pref equity fund and just put it on top of your common equity and cram you down to zero, and you literally wake up and that's happened and you had no rights to even vote on it. You had no rights to even contribute your pro rata share to it. You just wake up and you're crammed down, right? To Aleksey's point about like, oh, that didn't need to happen. That we don't need a recession for you to lose all your money. You could just have the correct capital call flexibility for the sponsor. You lose all your money, right? And so I have a very specific order that I look for and how the capital call is done to kind of help prevent that. But the point being is that you absolutely have to look at that going forward. I think too many people weren't looking at it and didn't realize the risks. And now the risks are all coming to bear. And had there been certain restrictions in their documents, they would have been in a better position to try to protect their capital at this point. So I personally absolutely hate when I hear of a story of someone not being able to at least invest their pro rata share into a pref equity stack if they were common equity to protect their capital. And frankly, it's happening left, right, and center. And it's really unfortunate because let's be honest, in the end of the day, the GP is obviously trying to protect their position as well. And sometimes it's a lot easier or a better result if they do that by taking advantage of the lack of specificity of capital call provisions to get themselves in a better position. So, but anyway, I don't have a very good direct answer to your question, James, because I literally don't think I have faced a capital call as a result of this carnage. I have to think a little bit about it though.
So in the operating agreement, you want to see that if they do a capital call, you have the right to contribute so that you at least are in the pref equity position. Is that what I heard?
I'll tell you what I like to see specifically. What I like to see specifically is 4 different steps of a requirement for a capital call. The first is that if a capital call is needed, obviously putting aside that it's not mandatory, that's absolutely critical. And putting aside there isn't some crazy provision in it that you get. I've seen provisions literally just because I read it and I passed because I've seen someone say, if you receive a capital call and you don't provide your capital within 48 business hours notice, you'll be diluted 50%. And that's, by the way, completely legal because it's what you're agreeing to when you sign, right? So you have to read them. But I like to see it in this order. I like to see internal debt first, meaning to investors, we're going to raise debt first, then internal equity. So now second step is you can get diluted, but it's internal and you have the ability to cover your piece. The third step is external debt, okay, which would be pref equity because often you can't really put debt on it, but it's kind of, quasi debt. So that isn't diluting you at least, right? And then external equity is last to me, where you get truly diluted. So I guess I'm wrong about the external debt being pref equity. It's really pref equity is the external equity, right? Because it's pref equity. But that's the order I like to see in where the last step that it has, once it's gone past the internal people first in 2 different waves, then it can go external. And the last step is really getting diluted. That just isn't there in a lot of the cash call provisions. And it's why some people are just waking up one day and getting crammed down.
Aleksey, have you experienced this capital call provisions on your investments, or have you what's sort of the thought process? I'm sure people have reached out to you on this.
Yes. Where do I start? So I guess for context, I've advised a ton of people on capital calls, all types across all types of assets, all types of sizes. Let me start from the beginning, if I may. I think something that's unhealthy, and there's a reason for it, but it's unhealthy, is the notion that capital calls are bad, because capital calls are a function of business, and some capital calls are good. In fact, some capital calls are actually expected. For example, if you buy into a fund, typically there's sort of like a draw period where you're like contributing capital every quarter or whatever it is, right? And those capital calls are totally fine, right? Another capital call that's totally fine is like, I'll just give you an example. Like you're like 90% done with your development, like you just hit a little bit over budget, you're almost there, the numbers still pencil, right? Like everything actually makes sense. And like the 2 alternatives are like raise more money or lose the property, right? Even though like your equity is in the money and everything seems fine, pre-leasing is going, right? Like so there's like different levels to this. Now, what people associate with a capital call is like roughly speaking, your equity is completely gone on paper. In other words, if you were to sell the property today as an equity holder, you would get nothing back. And what this had actually led to, which I've publicly called out, and I'll do it again, is like some GPs have gone out publicly and said, we'll never do a capital call. And I just think like that literally, to me, like that literally doesn't make any sense. Like, how can you say you're never going to do a capital call? Now, I can tell you just from the perspective of an LP, when they hear such a message, what they think it means is the portfolio is healthy. I'll never need your money, so invest in my next deal, right? So like everything is fine. Everyone else is getting capital calls, but I'm never going to get one. Therefore, when I get the next investment, like this is my sponsor and I should go all in again, right? The problem with that is behind the scenes, the same day that the sponsor announces that they're not going to do capital calls, they speak to a pref provider externally about providing capital, right? And then like on and on and on. But my point is like as Jeremy said, there should be like sort of like, I mean, forget docs, like there should be like some ethics, I think, in my opinion, in terms of like, hey, like you invested in this deal with LPs, maybe you should like let them know first about what's going on, right? Of course, ideally you're also protected by docs, right? But okay, so that's like that's the maybe a bit of a long intro, but I think it's an important one. Um, in terms of like what to look for in a capital call, just quickly, um, I think there's like roughly speaking 6 basic things, and you'll be surprised at how basic they are, but they're important. Like number one is, do you actually have the cash, right? Like I've had people reach out asking to borrow cash or borrow their on a 401k in order to fund the capital call. Number two is, will this capital call actually solve the problem? In other words, is this a capital call for, I'll just give you an example, happens all the time. Hey, we need more money. And if you, as Jeremy said, if you don't fund the money, like you're going to get diluted 50%. Right. And then, and then you start looking at the information and it's like, well, okay, so this capital call is for a rate cap that's expiring, right? That's what the uses of the funds are. But like, hey, you forgot to mention that like in 6 months our debt is coming due. What are we doing about that? Oh, you're gonna do another capital call in 6 months? Like you didn't tell me that, right? So in other words, like, is this capital call actually solving a larger problem that's going to get you to the finish line? Number three is, as Jeremy said, is like, what happens if you don't do it? Right? Like if and there's no rules on this, right? And many times I would say like the capital call notices are extremely vague about something so basic. Like if you don't invest, X happens, right? Well, in some cases that's like you get diluted 50%, which is pretty painful. But by the way, sometimes it still makes sense not to invest, even if you get diluted, right? But for example, if you just get diluted pro rata to whatever the capital invested is, well, like that's not such a hard decision. It's not so bad. Like, yeah, like if some other people are investing to save your equity, like, yeah, let them have some space, right? Not so bad. But again, they're not made equal. So that's the next one. Um, Number four is again something that's not talked about at all, is like, how's the existing investment doing? How much is my equity worth? Like, if I invested 100 grand, is the 100 grand still there, or is it worth zero now? And then and then five and six are like a little bit more complicated. I mean, like five is, you should think about this capital call as like it's almost like an independent investment decision, right? Like if you're and because it should be, right? In other words, like if you put in 100 grand and they want 50 more, you can put that 50 in the stock market, you can put it into some other new syndication or whatever you want, or you could put it into this. So if you tell me that you expect this 50K not to make much money, but hopefully get your money back, I'll tell you you're crazy. Like go invest it somewhere else. There at least you can make a return, right? So there has to be some sort of like relative comparison between where you're going to put the 50K out compared to the opportunity in front of you. And you literally can't do that without some form of financials from the sponsor. And then number six, just quickly, is like you should probably take down some lessons, right? It's very easy to just be like, oh, this GP sucks, capital call, you suck, right? I think it's a lot
That's
harder.
it.
Like it's a lot harder, and I'm telling you, I've seen capital calls where like my gosh, like the GP is a gem. Like they like communicated right on time, like they've literally done everything in the right. And like just didn't work out. Like, this happened, that happened, whatever, like, and like, okay, so like you can sit there and blame the GP and say like they're the idiot, or maybe like some of the stuff perhaps could have been foreseen before to some degree, right? What questions could you have asked before to not land where you are today? And then, it's a hard thing to do, but I would say it's highly recommended.
Yeah.
James, can I just add a couple of really quick things? I know
Yeah, go for it.
So number one, I'm sorry, I want to clarify for everybody because I'm in over 60 different LLCs right now. So I do remember one capital call I was involved in the last couple of years. That was in a senior housing project, completely unrelated to, it was completely very odd, like regulatory problems. We had to put money in all kinds of like nothing to do with interest rates or the economy or anything. And there may have been one or two others. I just in full disclosure, because I'd have to like think about it. But the other thing I want to say is that there are definitely other reasons, positive reasons for capital calls for those of you who are not familiar with. The most common I've experienced over the years is with office, retail, and industrial. I've had numerous capital calls across each that were unforeseen. And the most common scenario is, tenant XYZ wants to take an additional 20,000 square feet in our office building. This was not budgeted for, it was not projected. So each person has to put in their pro rata share, but here's a calculation of how much more cash flow you're going to get and also how much more the building's going to be worth. And to Aleksey's point, the critical thing is that you treat it as an equation and investment, right? Because everything else is a sunk cost before it. It just has to be a new scenario. But I've been through plenty of those with government expansions multiple times in some buildings and all kinds of stuff where it made complete sense. And sometimes they are positive. Right now, the vast majority are for challenging reasons.
Yeah, back at GE, we would give good news money, not bad news money, good news money for office, industrial, retail. So
there you go.
So let's go to a little bit more positive subject. So let's go into your ideal investment. I call this green lights versus usually we talk about red flags, which we will talk about, but sort of what's your box? We talked to a broker earlier today, and he said these buyers, their boxes are getting smaller and smaller in terms of what they want. So in terms of your investment criteria, what is your box? So Jeremy, we'll kick it over to you and maybe tell us about your box that you're looking for.
Yeah, so what's interesting, and maybe I'm an anomaly, is that my box has been the same since I defined it probably 20 years ago, since I kind of had a few years to beginning to define it. And it literally hasn't changed. So I'm hardcore focused on cash flow because I got out of the corporate world in 2007 from the cash flow. So I look for predictability because I want to go to sleep tonight, wake up tomorrow, and not much has changed because I live off the cash flow. So I want that predictability. That's why I got into all this. So I tend to target a class A- or B+ property, which typically means 1990s or newer, preferably 2000s or newer apartments these days. That would be kind of an A- or B market outside of very volatile and expensive markets like California, certain parts like New York, Miami, et cetera, where the prices go up and down a lot. I want to be in a more steady market with more preferable cap rates. I definitely avoid tertiary markets. And I want to go into a property that's 80% plus occupied, preferably 90% plus occupied, definitely stabilized, may or may not have any value add upside. With a diversified tenant base and multifamily, I'm most comfortable for sure over 100 tenants in a building or 100 units, and preferably over 200. I always target non-institutional versus true Class A for better cap rate, better returns. And actually, one very important thing is I target positive leverage. That's actually what kept me away primarily. Besides the fact that I look for a longer term fixed rate loan, I target a 10-year fixed rate loan optimally. And again, that's not because of what happened in the last years. It's literally what I targeted the whole time. But I tend to target a fixed rate loan longer term for more predictability. And I target positive leverage. So you talk about green lights. The number one thing I am focused on as an LP is getting a return that is commensurate with the risk. There has been negative leverage for years with these floating rate deals. That was a huge flag to me. And positive leverage means you are getting paid for the risk and versus what the cost of the debt is. And if you took a look at the chart that James shared earlier, especially small balance loans, et cetera, I mean, you're talking about 6.5% to 7% or 7.25% interest on even a Class C property that might be a 6.5 or 7.5 cap, you're either negative leverage or maybe neutral. Historically, on a Class B property, you should be at about 125, 150 basis points, just to give people a kind of a starting point. And that's different for Class A and Class C. And James can definitely, and Paul can, and definitely, and Julie can share more specifics about that. So the big green light to me is the correct amount of positive leverage, because what that tells me is that the pricing is back to where it should be. And right now, in my opinion, we're still overpriced.
So something has to give.
Relative to the debt, relative to the cost of debt. Sorry.
So either interest rates have to come down or cap rates have to keep going up.
Right. And I think we're going to see a combination of both, but I think it's going to be more heavily weighted towards interest rates coming down that were forced down to a recession in response to a recession, while cap rates will still adjust a little bit because you're going to have even less capital, both on the equity and debt side, available during a recession. And that will create less demand, and that will theoretically mean a slightly better pricing, even though there's already been a big adjustment. So I'm expecting both sides to work that and create the more positive leverage.
So go back to 21 real quick. So in 21, 10-year was like 1%. So you could have gotten 3% debt on agency and bought on a 4 cap. Is that enough, or is that?
Well, it depends on where that property is. Like I would avoid, for example, if that was in LA, that's one thing because it's very volatile. So it really depends on where it's located and a lot of the factors in the occupancy rate, et cetera, as you know. But I would argue that, boy, did I not see very many 3% loans, if any. I have to go back and look at my notes. I've heard stories of under 3 even on some stuff.
The challenge was the leverage. So you could get the 3% rate, but then you had to put 50% down.
Yeah.
So everybody passed on that.
That's another part of my box, right? Because I would pass on that too, because then I'm not getting the leverage I should be getting, in my opinion. That's still not even putting me at great risk, but increasing the return. So my leverage, my box is my optimal 65 to 70% loan to value. I go max 75 at the beginning of a cycle, nowhere near the end of a cycle, but I strongly prefer 65 to 70. It's like the sweet spot for someone like me who's pretty low risk, yet I want some leverage. So at 50, to me, it's almost like too low risk, and therefore you're not getting enough of a return.
Yeah. Okay. Aleksey, I know you definitely look at multifamily a bunch now, but in your previous days you did not. So talk about green lights, maybe across multi and across what other property types.
Yeah. So just I have a quick comment on what Jeremy said. I think they're all good ideas. One thing to look out for, which I'm seeing a ton right now, is like you open up a deck and it's like front and center, positive leverage, amazing, blah, blah, blah. And then you go to the sources and uses, and there's like a somewhat big closing cost, right? And you ask about it, and it turns out that like they're paying down the rate. And so what that actually means is they're using LP money to make this positive leverage, which I don't know, up to you guys to decide, but I don't think that's positive leverage.
Yeah, no, that's not what I was talking about.
I'm sure. Yeah, I'm sure Jeremy would agree, but I'm just mentioning it because it's like it's literally all over. I see it like once a week. In terms of like deal characteristics, I'm weird. I don't know, like being in the institutional world, like I mean, like I ran a 20-person team, and I saw like I don't know, like we probably ran through like 20 deals a week ish, right? And once you see so much, like it's like it's almost backwards, but it's like I don't know, Jeremy, you're probably like you're crazy for saying this, but like I don't really have deal terms, right? Like what the way that I like to think is like things need to make sense, right? And like for example, I'll just give you an example, and this maybe is a good segue into um red flags, for example,
Red
right?
flags,
Which I
okay.
don't like. I don't like using red flags. I like to read to call it reasons to stop and think, and this is a great segue into that actually. So like I'll get this all the time, and LP calls me and like, hey, I want your help. I got this investment, but it's like I think it's crazy because it's a 50-50 split. So like that's terrible, right? And I'm like, I don't know, you didn't tell me enough information.
So it's in combination with everything else. It's not just one thing that will
exactly. So that's my point is like, and I think that a trained investor needs to be able to see like, well, I can't answer that question, right? Like, what if it's a 50% split, but it's a 12% pref, right? oh, and by the way, they're investing 30% of the equity, which is much better than market, right? Like I don't know. Like, is that a bad deal? I don't know, right? But you need to be able to look at different factors and be like, oh, like that's a reason to stop and think. Meaning, I agree with you that if something is 50%, that's not standard. But the question is, as you keep looking through the deck, are there reasons to be like, whoa, that's not normal, that's not normal, that's not normal? And at some point, you're like, okay, like this deal is not salvageable, right? Or you have like sort of redeeming qualities that get you back to be like, oh, this actually kind of makes sense. Oh, and that makes sense, or and this makes sense. And I'll just quickly tell you, like, I've said this publicly. Um, I think the best LP investment I've seen in the past year was an office deal, literally vacant office building in Phoenix, right? And um, I, it happens to be that like I sent it to a few people, just like friends that were looking for investments, and all of them are like, "Oh, office, I don't know, like that's crazy," right? It's like it's very easy to like talk about investing in distress. But once you actually like see how it looks like, you're like, oh, I
It's
don't
not
know,
as
like I'd
easy.
rather
Yeah,
I'd rather maybe do like a multifamily, like maybe a class A or something, so it just depends. And like you have to train like the deal muscles. I don't know how else to say it.
yeah. I mean, everybody's risk tolerance is a little different, right? And so, um, I it's taken us a little bit longer to get to these topics than I thought, but maybe hit your red flags real quick before we
And
jump
James,
into questions. Yeah.
in case it's helpful, I don't have a hard stop at the hour.
Okay. All
Honestly,
right.
for me, it was just a question of getting in the other room for dinner with my family, but that could wait. So,
Okay.
I can
Well,
stick around for this part of the whole session.
okay. Yeah. Stay as
Yeah,
long as you guys can, and then if you got to
yeah.
jump, no worries. So
So,
let's hit the red
yeah,
flags real quick.
yeah. So just
Well,
real quick,
yeah.
red flag. So just so to me, huge red flag is beyond a 50-50 split when it's 40-60, or if it was 49-51 in favor of the sponsor. That's where I personally draw my line. I just move on immediately. I've actually, to Aleksey's point, I've made exceptions. I've invested in a 50-50 split at a 10 pref with a top 5 mobile home park operator in the US to get access to them in a diversified portfolio of tens of properties and locations I like, the cap rates that were exceptional. They have unique access to get, right? Where the fees weren't that bad. And it's actually turned out extremely well. And so, to Aleksey's point, you always have to look at the details, right? Other red flags would be operating agreement. I just cannot stress that enough. And if there's crazy cash call provisions, if there isn't quarterly cash distributions, quarterly reporting, that's kind of a requirement for me, right? Because once in a while I'll see a deal that's annual cash distributions or maybe semi-annual reporting, et cetera. And then if things don't fix the general blocks that I mentioned before, whether it's because of market, because of asset type, because of age, other reasons, I typically won't make an exception. It is always worth looking at something to see if it's really unique and worth the hurdle. But I really would caution people that if you have a box, to try to stick to it, because that has been very helpful for me. And it actually keeps you out of trouble, and it keeps you from kind of reaching beyond pricing or some other cap rate or positive leverage that starts to get you into trouble sometimes when it's hard to resist, because that helps you to kind of reduce risk at certain times in the cycle. But anyway, I know we're short on time, so I'm going to stop there. There's other red flags too.
Aleksey, red flags on your side that Jeremy maybe didn't touch on?
I don't have red flags
It's all green.
except for um I call them reasons to stop and think based on what I
Okay.
kind of tried to explain earlier. There's two exceptions to that. Number one, the word guaranteed,
Mm.
in any sense of the word. And like I have a whole article on this, like if anyone wants to read it, they can. I think it's called a guaranteed red flag. Um, um, like, people will tell you all types of stuff. Oh, like, I'm worth 100 million. Okay, like, does my LP investment come with your personal guarantee? No, it does not. It's not guaranteed. Like, I mean, I can go on and on, but like, as soon as you see that in a deck or like any type of pitch, it immediately signals. I mean, first of all, I mean, not a lawyer, but I'm pretty sure that's like a securities violation. And number two, like I just don't think they're being honest. Um, The second red flag that I've publicly put out is a lack of a return of capital clause, which I've actually seen. In other words, like you LPs come in and buy a property, the GP sells it the next day because they changed their mind, and then there's just a 50-50 split. Like there's no return of capital to LPs. Why would you have that?
Right. Okay. All right. So that's your red
That
flags.
was sarcasm.
Yeah. Yeah. No, I got you. So, in terms of whether it's the capital call or we've seen some GPs sort of underperform, what rights do LPs have to do anything? Like we've seen, I mean, I was talking with someone today and the GP pretty much, fell asleep at the wheel to some extent. And now the LPs had to come in and take over the deal and, hire a new property management company and everything. Um, have you seen that on any deals and any strategy tips there? We'll go over Jeremy first.
Yes, I haven't. So I did experience that actually in 2019. That was due to it was due to a management problem. We'll leave it at that. And we basically switched from one GP to another. It was a long process, but it happened. I personally helped actually make a switch from one GP to another in 2012 in a single family kind of purchase, rent, and sale fund where we had a manager dispute, and then the on the ground managers that actually knew what they were doing left. The back office IT guy stayed and was mismanaging everything. So I kind of negotiated a release of liability for him in exchange for handing over the property so we could put a new manager in. But I think that I want to point out a very important point on this point. If let's say that investors are unhappy with a GP for whatever reason, and they want to vote them out or replace them, you have to look at the voting rights in the operating agreement prior to investing. Because one of the most common loopholes I see where you can never actually reasonably get rid of a GP legally is GP co-invests 10% of the equity, right? So now they're 10% of the LP vote. There has to be a supermajority of vote that says that basically you're required to have, I'm just making this up, 75 or 85% of the vote to vote out a manager, which actually sometimes isn't even in there at all, and it's not possible to do, right? But let's just say it's 75. And let's just say that the LP vote of 10% of that is the manager. So they're never going to vote themselves out. So now you have to get 75 of 90, right? Well, let's be realistic. If it's a very big diversified base of investors, it's going to be very hard to get everyone to respond, right? And maybe not everyone will agree because a couple of people are friends of his. And next thing you know, you could literally never get rid of the GP legally because that's the way the docs were written. So if you're going to scrutinize the docs, always look out for that. And then if you see it, what has happened many times to me over the years is you approach a GP and say, hey, your shares or any of your affiliates should be excluded from any manager replacement votes because you're not going to vote yourself out. And there's been many times where they would say, oh, I didn't even know that was in there, because often they don't really know the docs very well from a legal perspective, right? They're not an attorney, and they'll actually deal with it and actually fix it. Sometimes they won't, and that's when you pass, right? But I want to point out to everybody that I've seen this many times, and it can really prevent you from being able to remove a manager ever. So be careful with that.
Somebody commented that sometimes the loan docs don't allow you to remove the GP.
So yeah, and so the loan docs, and as you guys know well, James, those can vary tremendously on that provision.
Sure.
And I've actually been in, so the instance I mentioned in 2019, when there was a replacement of managers, there was a requirement of the new manager to be approved on each of those loans to assume the loan provisions.
Right.
And because we brought in even more experienced manager, the manager had 3 decades of experience I was with. We brought in an even more experienced manager. And because of that, and because of their net worth was even higher, the various banks, and it was different banks, agreed to replace them across the various properties. So even though the loan docs may not allow for it, it doesn't mean it isn't necessarily doable.
Gotcha. So stronger guy to come in and take over the deal.
Yeah.
Aleksey, anything on your side in terms of you can touch on any of these: GP underperformance, short sell, capital call. What have you seen LPs do?
Okay, I guess context. I've been involved in like all types of workouts, lawsuits, on behalf of LPs. Maybe I'll say three things. First, knowledge is power, number one. In other words, like, I don't know, this sounds counterintuitive, but I don't think passive investments are passive. Unless you just like, don't want to know what you're invested in, but then you can't expect to sort of like influence something, and help yourself. Um, what I like to say, I think it's an article even, I think I called it, um, passive investments require active monitoring. Um, Number two is being early is a huge superpower. In other words, um, um, if you identify an issue early, a few things can happen. First, um, you might get bought out potentially, right? Like for just almost just like literally being annoying, right? Um, like but here's the thing. I mean, and this is counterintuitive. I wish it wasn't the case, but like if you ask to get bought out with 60% of the LP pool, that's just like not a realistic ask, right? Like where are they going to find the money, right? However, if you're like 100 grand out of a $10 million capital stack, then it's like, okay, like stop annoying us, like we'll figure it out. And sometimes you get taken out. So in a weird way, like in these situations, sometimes um there's strength in numbers, and sometimes in my experience it's actually like usually it's quite the opposite sometimes. Um and the third thing I'll mention is um I don't know, maybe Jeremy, you might disagree, but like you should definitely understand your rights, right? But LP investments are like it's not something I would invest in because of their rights, right? Because like the rights are naturally limited. Like that's like the what word am I looking for? The baseline, like a basic uh LP investment with all the right um um legal frameworks and everything, at the end of the day, does not give you a ton of rights. It just doesn't. Like that's just like the nature of them. And so I would just keep that in mind. Like if you want to be actively involved and like control your destiny, so to speak, like um you can control it by investing really well. But once something is already in place, it's very difficult to sort of like figure out changes. It happens, but it's not the majority, is my point.
And
Right.
I just want to say I fully agree with Aleksey. I think that the key is to understand that you're to know going in, knowing your rights are limited, and actually being aware of what rights you have and what rights you don't have. Because one of the things I often see is if people not fully understanding their situation going in as an LP investor and then being surprised because they didn't have certain rights, or surprised, for example, they couldn't vote the GP out, or surprised about other things that they could have done the research up front about to really understand it. I can give you so many examples. Like, for example, almost every opportunity I invest in, inevitably, at least one investor, mentions at some point, oh, the reporting isn't very good. And I'm like, well, you could have asked for a sample report before you invested with this person. You would have known what you were going to get, but you didn't ask for that, right? And honestly, I put that on the LP investor because they didn't do that piece of the due diligence, for example. I think it's a very important piece because to Aleksey's point, you're not going to be able to get it changed. And I've tried, it's just not going to be able to get it changed after the fact. You're one investor. So to Aleksey's point, you have limited rights, but Aleksey, I still think it's critical that people understand and look for where the holes are in the Swiss cheese and then be okay with how the Swiss cheese is before they go ahead and buy it, you know?
Perfect. So, um, I so what I want to do now is I'm going to open it up to questions from the audience. If you want to put your questions in the chat, we will try to hit them. And I'm gonna move to the quick fire round. What I'll do this time is alternate. Maybe Jeremy take one and then Aleksey take the next one. And think of it as like Family Feud. Like you got 30 seconds. This is a speed round because we got a lot of questions and we've got limited time. So let's just and I grouped these a little bit. So I tried to. All right, Jeremy, we'll start with you. This will be the speed round. Jeremy, best way to find credible syndicators.
Best way, in my opinion, as a starting point is try to get referrals from multiple investors who've had success across multiple opportunities with the sponsor. One quick caveat and note is that it is going to be much harder to figure out who to invest with going forward because besides all the other challenges, now you got to figure out if someone's under distress and one or more opportunities and they may be distracted if you're going into them with a new opportunity, even if it's in a year or two and it's a fantastic new opportunity after a reset, they may or may not be the right person to make a bet on at that time. So doing that additional layer of research is going to be critical because that'll actually be completely separate from regardless of whatever experience anybody's had with them in the past.
All right, referrals.
Yep.
Number two, let's go to Aleksey. All right, Brett asks, what is a tactful way to ask a GP about their existing portfolio to determine if they have any underwater deals?
I already know, I think I know what he's going to say.
Oh no, so there's actually many ways to answer this, but first of all, I'd say is don't be tactful, and
Yeah.
I'll tell you like it's tactful, but it's not tactful. I'll explain because like if you're trying to be too cute, the response will also be cute, and it will not be valuable, right? And I don't know if cute is the right word, but you guys get what I mean. Like the best way is you have to do your research and like you have to ask very precise questions, and I'll tell you like I don't know, like 50% of the time when I ask these questions to the GP on behalf of an LP, um, the answers are subpar and I have to follow up, right? Because like you like when you've been in the business long enough, you know how to answer something without answering it.
Right. Okay.
Let me just add, Brett, you don't want to be tactful because you want to get to know who you're making a bet on. And if it's a very, longstanding
Right.
professional, they'll understand why you're asking and they're just going to be straightforward with you. And if you don't get that, I don't know that I would actually even bother you. There's so many people you can make a bet on. I would not, if you feel like you have to be tactful, then maybe that's not the right person to invest with to begin with.
All right. Mike had a follow along on this. Pros and cons of going through a capital raiser versus investing directly through the GP. Maybe let's just start with what's the pro of using a capital raiser? Because I think we know the cons, but you hit the pros of using a capital raiser versus investing directly through a GP.
Who do you want to take this?
Jeremy, why don't you start?
Okay, so pros of using a capital raiser is that especially if you're busy in a job or you don't want to put the time into networking, you'll be able to find or get access to more opportunities. I'm just going to give you one answer for each real quick. Con is that very often the vast majority of the time, a capital raiser is in business to make a profit. They're a business, they have employees, assistants. They're going to be pulling people together into their own LLC and taking a portion of the profits or a spread and or some type of promote. So you basically could get lower returns sometimes, not always, by going through a capital raiser in exchange for getting access to more deals. And that may or may not make sense for a specific person.
All right.
There's other pros and cons too. I just gave you the quick, easy ones.
That's a good one. All right, Aleksey, we're gonna hit the next one. If you had to pick one criteria in evaluating a multifamily deal, which criteria is the most important?
I mean, I think people already know my answer to that. I don't like criterias.
All right, Jeremy, one criteria.
Who you're making a bet on?
GP selection. That's why I put it under GP selection. All right. All right. Let's see. Okay, so Jeremy, what are the benefits, pitfalls in investing in pref shares versus investing just, let's say, in common in a new multifamily deal with fixed rate financing? Any reason you would do just a pref deal versus a common equity deal?
I'm getting confused by the question because it's like either pref shares or investing in a new multifamily with fixed rate. But to me, you can either be common or pref in the specific deal, whether it's a new multifamily or not. So
I think what it's referring to is like if you had the same deal and you could either invest in common or invest in the pref, how do you think about the two choices? I think.
Okay, so I'm going to answer that question because I think it makes sense, Aleksey. So for me personally, because of my box that we talked about, because I kind of go into low risk, more predictable cash flow, or lower risk, more predictable cash flow, I tend to almost exclusively invest in common because the benefit is that you get upside while I'm already going into a relatively stabilized property with high occupancy with an experienced manager where a lot of dominoes have to fall before it goes bad. And it can go bad, but there has to be multiple problems typically for it to go really bad. I'd rather at least capture some upside if it's going to be there. I don't get that in the pref. Obviously, one of the pitfalls is that often if you're looking for just cash flow and nothing else, often the pref shares will provide you with the higher amount of cash flow than the common shares. One more thing is that I tend to avoid deals that have common equity and pref equity together because I don't want equity to be ahead of me as a common equity provider. And frankly, until 2020, 21, when there had to be more financial engineering at the capital gap to make numbers work, that wasn't even there. And that's only because prices are high. And I hope that goes away. And I'm guessing it will because it's probably cyclical.
But like when we were at NMHC, like almost everybody wanted to give out pref.
That's because they're trying to be defensive at the end of a cycle because it's technically less risk. But we'll see what happens if we do get a proper cycle reset.
If I may,
Yeah,
I'll just insert a quick comment that the worst deals I see on average right now are pref and debt. And the reason why they're the worst is that they have a perception of being safe. And many people invest based on that idea. But you have to understand that this is just another piece of a capital stack, which has its own pros and cons. And just because you're a pref doesn't mean it's a safe investment. I mean, like whatever.
Hopefully so when you say it's not a good investment or it's the worst investment that you're seeing right now, is that even though they're promising a high 15% pref, it doesn't mean anything because it's based on a cash flow that can't pay it. Is that what you mean?
Well, I'll just give you a practical example that I've seen. A debt, the debt on a property is 10 million. The property is worth 8. The property is worth 5. I've seen 4. You pick your number.
Okay, so you're just upside down on the deal already. So
yeah, you're upside down. But
yeah.
You're an LP, and all of a sudden it's like, hey, we're raising a new pref. It's 15%. Oh, and by the way, half of it is paid current from a reserve. Sometimes they tell you that, sometimes they don't, right? And it's like it's $1 million. So like you have all the common sitting behind you. It's amazing. You should invest immediately. It's like, well, equity, I don't know about that.
Pref equity is financial engineering, and it's become prevalent now because values were high and arguably are still high. And I'm telling you, if we do have a proper cycle reset, it'll be a lot less prevalent because we won't need the financial engineering with positive leverage to make sense of deals.
Yeah, you just be common. Okay, Jason asks, what's a quick test to see if a deal is worth a deeper dive? Jeremy?
My quickest test is the positive leverage at this particular point in time. But boy, there's a few tests you can do. I just want to keep this really simple.
Okay. Aleksey, is there a good tool or model to inform LPs to help them decide on an investment?
Not that I know of.
Okay. Do you run your own model typically? Do you just drop it into like an Excel or something? Do you put cash flows in Excel just to double check it? Do you do anything like that? Are you just looking at the
9
PDF,
out of 10
really?
deals that I look at don't get to that stage, right? Okay. Like there's 3 pillars that I look for. I don't want to get into all of them, but the first one is like vetting the sponsor. I would say a third of the deals don't even get through that.
Right.
I just want to add, James, that there are some tools that exist now that have been created the past few years. Some of them which can be found either on like a Passive Pockets or a 506 group, et cetera, where people have created either a spreadsheet or some type of tool where you enter a whole bunch of data and it spits out ratios and gives you even a rating. I don't use them, so I couldn't recommend one. But if you're new and you're looking for something, they do exist if you go searching, and they may be helpful for you.
Yeah, I mean, I think sometimes just putting in the numbers in a spreadsheet just to see if you're missing something or maybe something, because I think the challenge for a lot of people is that they don't know what they don't know, and they only, they might get a 10-page deck, but the sources and uses are missing, or something's missing where it's like the rent growth is missing on a slide, and all of a sudden you're like, how did they get that revenue number? And you can't see it in the slide. So when you drop it in to a tool, sometimes that will help you. All right. Let's go to the next one. So Wilson asks, how will cap rates and NOI change in a higher interest rate regime and potentially inflationary environment with the new administration? So I guess cap rates and NOI a year from now, I guess, is the forecast. Jeremy, let's go to you.
Well, if you look theoretically, what theoretically should happen, and this doesn't always happen for many reasons, depending on the cycle, but theoretically, what you would expect to happen is that if higher interest rates exist, it's a higher cost of capital on the leverage, and therefore there would have to be a lower price, which is a higher cap rate, essentially, that an investor would pay if you're targeting a certain return commensurate with the risk. There's a lot of factors, though, that go into that. It's how much supply of debt and equity there is at the time, which could affect how much pricing power there could be from the seller. But just theoretically speaking, what I just said is kind of mathematically correct, I think.
Okay. Any thoughts on NOI?
NOI is tough because it depends on whether you believe we have recession or not. If we have stagflation with very slow growth and inflation, you're going to have the lack of ability to move rents for very much at all, because you have a weak economy and people cannot earn much higher incomes, and then you have higher costs and therefore your NOI is lower. So
does the lack of new supply drive rents though next year?
Well, the lack of new supply is no longer a drag on rents, but it's one of many factors, right? You see what I'm saying?
Yeah. I mean, people can't pay it. Yeah, people can't pay the rent. They can't pay the rent, right?
Right. And so a recession could be a drag on rents. A lack of supply can be a drag on rents. Excess supply can be a drag on rents, right? A lack of supply can help with rents. So these are all like variables that go into the whole equation. But so the better supply situation will be helpful for pricing power on rents, but it's not the only piece of the equation. That's why I keep saying, if we have a recession, everyone seems to be ignoring that piece of the equation for persist till 26.
Right. All right. Aleksey, hit this one. Rafa asks, should I wait until all the foreclosures start to happen before I invest?
First of all, they're happening.
Okay.
I'll just start there. I mean, they're happening left and right. But I think what I would modify about that question is, should I wait until the foreclosures start to happen to start learning how to invest and evaluating deals? The answer to that is absolutely not.
Right.
You can do that now, right? And if something looks interesting, then you invest, right? But there are amazing deals happening today. It's hard to find them, right? But you have to
you got to be in position.
Time.
Yeah, you got to be in position.
Yeah.
Did you have
James,
something,
can I add to that real quick?
Yeah.
Which is, I would be very careful with the concept of just focusing on foreclosures, because with the amount of extending of loans that have occurred, if that continues and the lenders can continue to do that, what you may find is pricing get better over time due to a higher supply of properties coming online. They're having some distress, but not necessarily going through a foreclosure process per se, right? And so, and also I would also kind of add on to that and layer on the potential of recession causing a bit of a reset in general, which may or may not culminate in foreclosures. It could be all different ways that this can happen, short sales, et cetera. So I would just be very careful with focusing only on foreclosures. And I would focus more on, what do you believe you need to see to where the coast is clear, where you think it's the right time to invest. For me personally, it's either to validate whether there's going to be a recession or not, and or to see positive leverage. And I think you should think of it more in those specifics as opposed to just the foreclosure piece, which that's just one variable and it may or may not happen, but you still may find really good deals.
Yeah, I think it's just what hits the real deal, right? So whenever something hits foreclosure, it just seems that much more dramatic. All right. So this next section I'm calling Crystal Ball because it is hard. So if you want to give your 2 cents on it, you can. Maybe we'll start with Aleksey on this one. Manisha asks, how will Class A properties perform compared to B and C over the next, let's say, 12, 24 months?
There's not enough information to answer this. Perform in terms of what? Rent growth,
Yeah, everything,
returns,
occupancy and rent growth. Like,
right?
what if I had to put 100,000 into an A deal or a B C deal, uh, in terms of NOI growth, let's say. That's
I don't think that way. I mean, I
okay.
can tell you if you're asking about occupancy, like if that's the question, um, I think probably B and C struggled before A, um, which is a whole another topic about, the fact that loss to lease is starting to become gain to lease, and I think that's like a big problem that we're going to see this year.
Mm. So
Uh,
can I just add,
yeah, go
James,
ahead, Jeremy. Yeah.
just very important point. So as a lot of people probably know, there's been a lot of deliveries of Class A properties, A minus properties in the past year or two in terms of increased supply. And that is dragging down pricing power potentially due to a lot of free rent and other types of promotions that people have been providing to fill up those buildings, right? So there will likely continue to be a drag, and this is market dependent. But on average, in the popular markets, Class A properties are going to have a challenging time maintaining rents or having rent pricing power so long as you continue to see that supply. This year, next year might start to be a little bit different. But to Aleksey's point, the problem is there's so many other variables in there. So I was just trying to answer it without getting too much in the weeds.
Okay. I'm gonna wrap with one last question. I've got like 10 more, but I gotta wrap this up. So I appreciate you guys coming on. You guys put out so much stuff and you talk to so many people. So thank you for doing all that. If you had one piece of advice for the LPs out there going into 2025, what is your one piece of advice? Let's go to Aleksey first, and then we'll wrap it up with Jeremy. Aleksey, what's your number one piece of advice for LPs out there?
I'm gonna go with the name of an article that I just published,
Okay,
which is
sure.
deal flow rules the world.
Okay.
What do I mean? The best thing you can do for yourself is look at more deals.
Do you want to plug your thing? I don't know what you're calling it. Your match, GPLP
Yeah,
match. Why don't you just tell people about it real quick?
yeah. I mean, if you can reach out to me, basically you sign up and you get deals for free. Like you set your filters to whatever you want. If you want to only see multifamily deals in Ohio above an 8% pref, that's the only thing I'll send you. Yeah, I just think the best thing you can do for yourself as an LP is like look at a lot of stuff, and then you can start comparing. Like, oh, maybe that deal wasn't so good. Like, I didn't realize that some sponsors include sources and uses in their deck. Oh, I didn't realize that X, Y, and Z. Like you need to get your hands on more deals. Look at them, understand them, evaluate them. Of course, this requires time. I'm not, ignoring that, but like if you don't have time, then probably not the greatest venture.
Right. All right, Jeremy.
So I'm sorry, James, I'm going to give two quick answers instead of
Okay,
one.
yeah, go for it. No
Can't help
problem.
it. One is anyone out there considering pref equity and debt, I'm going to say the same thing I told people on floating rate loans in 21 and 20, okay, than I am for this. We potentially are at the end of a cycle. That is a very dangerous time to do debt and pref equity if you think it's potentially perfectly safe without understanding of where we are in the cycle. So you're welcome to have your own opinion and maybe think we're not going to have a recession. That's of course okay. But at least be sure you research all that and formulate your own opinion about where we are in the cycle before considering any of those, because I think a lot of people are not doing that right now, unfortunately. And so that's number one for 2025. Number two is keep in mind that the stock market moves very quickly and real estate moves very slowly. In the stock market, I'd rather, you can lose out if you're too late, but in the real estate market, things move very slowly, and I'd rather be too late than too early. I've seen too many people get burned in the last downturn trying to catch a falling knife. And frankly, you didn't really lose that much on waiting. And what you got was a benefit of getting more clarity and having a number of years of taking advantage of very good pricing because things don't rebound nearly as quickly as the stock market. So keep that in mind. It's not a rush, and just formulate an opinion of where we are in the economic cycle and then go with that, based on your opinion.
Well, thank you guys for coming on. I really appreciate it. I know it's late in the day, and this has been super helpful for myself, for everybody who's on. So thank you guys for coming on. And if you've got to jump, completely understand. What we're going to do now is move into just sort of we're going to stop the recording and move into just networking with the people here. We're going to break into breakout rooms just to make it a little bit smaller and have you guys go from there. We'll have probably one Old Capital person in each room. And the first group will be just a breakout by random. And then if for some reason you're tired of that group, you can pop out and I'll put you in a new group. So we will do that now. So I'm gonna stop the recording. Thank you, Jeremy. Thank you, Aleksey, for coming on. You guys put in the chat everything that, and follow them on LinkedIn. Jeremy, Aleksey, any final, what's the best way for people to follow you guys before we jump, actually?
Yeah, let me just jump in. I just want to say one thing before I even say that.
Oh, yeah.
Thanks again for having me here today. And I'm sorry earlier, Paul, Julie, I really should have shouted you guys out as part of the old Capital team. You guys provide amazing, both of you. I know I mentioned Aleksey and James, but you guys both provide amazing education. Julie, you have amazing questions on your podcast like every week. I've been on a couple of times, but I know you get really great guests and you're doing it very consistently for years now. Paul, I know you do a great job sharing info with James, and does the community really appreciate what you guys are doing on the LP side? It's highly valuable, and I refer people to watch you guys all the time. So thank you. Sorry, James. And so my email is the best way to reach me. If anyone wants to reach out to me, don't hesitate. It's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com.
All right. Aleksey, what's the best way for people to follow you and get in touch with you guys? Is it email?
I just shared my email.
Okay.
It's like not so easy to spell, unfortunately.
No worries.
And I also earlier I shared the link for the GPLP match in case it's helpful for everyone. It's totally free to sign up.
All right, perfect. Well, what we'll do is break into the breakout rooms and maybe do some intros, and then maybe share your thoughts, maybe number one thing that you learned tonight, and we'll start with that one and go from there. So I have not done breakout rooms in a while, so I will try it now. Hold on one second.